Good morning. Welcome to the mortgage rate forecast with Criss. It is September 29th. As always, let's start with the charts. We open up pretty low today. I'll get into the reports on that later, but we're currently trading up pretty nice today. I wish you could see the red and green on this 3-month chart, but we're trading right up here at about 104.13 right now. Support's coming in below us, pretty well below us at 103.88 and 103.78, and resistance is a little bit above us at 104.16 and $104.34 up here. So here's the reports. We opened low. I think a lot of it was because of jobless and GDP, but the pending home sales weren't so great for the economy, helped out the bond market, so that was good. Treasuries are down, and also, one reason for a little bit lower of an open is Yellen came out and says, she sees an increase sometime this year of the Fed short-term rate. So the percentage of likelihood for the Fed to increase the short-term rate, though, since the 15th has gone down from 54% to about 19%. Either way, that's going to have a negative impact on how your 30-year fixed mortgages trade, just with that coming up. Because remember what happened last time? Right over here on the charts, this is when they came out, the Fed came out and made a few comments that they might increase the short-term rate. We saw the bonds trade all the way down here, which brings with it higher rates, higher fees. So when the Fed came out and said, nope, we're not going to increase the short-term rate, which I believe was this day right here, we saw whoop, bonds improved, bonds did better. So, when they make these comments, it does have a pretty big impact on it, even though it hasn't happened yet. So anyway, something to watch out for. To kind of quantify where we're at, the Freddie Mac reported last month the average rate was 3.44% at 0.5 points. You can reference that down here at the link. And so average trading last month was right around 103.70. To kind of quantify where we're at, if we were at 103.70 on average last month, and we're currently trading at 104.13, that's 43 cents better. So where last month somebody might be paying a half a point, we're not going to be paying much over a point to probably get a similar rate on average in the market. So anyway, that kind of shows you where we're at. Okay, forecast time. This is hard. This is hard right now. It's really inconsistent. The analysts are all over the board. What I call the pessimistic analysts that I follow. This whole time he's been bearish. Bearish meaning he didn't think bonds were going to really trade very well. And then Fed came out and they traded well and he was still bearish. And they kept trading well and he was still bearish. And guess what? Now bonds improved, they got better, and then he was like, okay, now I'm going to go long. I think this is going to be good. And then now he's back to bearish again. And so the other analyst, he's defining an upward trading channel for mortgage-backed securities, so he's a little bit more bullish. Guys, it's a hard call today. So I think the trading range until next week is going to be somewhere between about 103.90 and 104.20. So I think we have a little bit of room for improvement, a little bit more room for loss. We are at the upper end of that trading channel in my perspective. So, I don't think we're going to see any major changes. So it's nothing to sweat. But I think we have a little bit more room for loss than gain right now. So, I'm a little bit more conservative, but I don't think the sky's falling by any means. Anyway, so what would I say? Hey, if you got to close your escrow here pretty soon, maybe not bad idea to lock in. Otherwise, if you have some time to float, we have developed an upward trading channel. We haven't broken out of that yet. So, you might want to just hang in there, but you're going to see if I could guess, it's going to be kind of like a yo-yo going up an escalator. But keep in mind, 104.20 right here, 104.20. I mean, that's the 5-year low. It's going to be hard to break that. It's going to take a lot of bad economic news, and I just don't know if we're going to see it. So I'd be a little careful. Okay, we would love to hear from you. What do you think? I don't know it all. Maybe you know it all. Maybe your predictions are better. So leave your comments down below. Let everybody know what you're thinking and why. We'd love to hear from you. And everything likes to be liked, so does this video. And if it's your first time on the page, up at the top left, you can hit subscribe. That will get you a quick little reminder when we have new posts come out, and you can help kind of track the market, get a feel for it. Once you buy your house or refinance, you can always unsubscribe. And if none of this made sense to you, it's okay. At the top right is a little guy scratching his head. Click on him, and that'll take you to Mortgage Bonds 101. It'll teach you the basics, how mortgage bonds trade, and how this impacts you as a consumer getting a mortgage. Anyway, that's it for this week. Have a great weekend. We'll be on here next week. Take care. Bye, guys.